Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Monday, April 20th, 2026. The vibe, nervous but controlled. We had fresh US-Iran tension, oil ticking higher in the background, enough to make people de-risk, but not enough to spark a real sell-off. Bottom line, stocks didn't crash. But selling in the mega-cap tech names kept the tape heavy all day. Under the surface, money didn't leave equities, it just rotated into other pockets of the market instead. Now look at the S&P 500 heat map. This was the key to the day. You've got a slightly green background, more winners than losers, but your eye goes straight to the biggest boxes, and those were red. Mega-cap names like Microsoft, Google, Meta, Amazon, and Tesla really weighed on the mood. Meanwhile, financials and industrials showed steadier green blocks, helping keep the tape from turning into a full-blown risk-off unwind. So what was the money doing today? It looked like a classic rotation day. Traders sold what they owned, the crowded mega-cap communication and platform winners, and shifted into areas that usually screen better when macro risk picks up. Banks and capital markets were strong, industrials held up, energy got support with oil moving higher, and that small-cap strength alongside a weaker Nasdaq is a big tell here: reallocation, not evacuation. Here's the context that ties it all together. The market's main tension didn't resolve today. Geopolitics pushed oil higher, which drags inflation and rate risk right back into focus. And remember, the market's been running near record levels. So instead of a clean breakdown or a clean breakout, we got something else: rotation. The day basically postponed the bigger decision, with traders trimming concentration in the biggest growth leaders, but staying invested through cyclicals and value pockets. On the chatter front, there really wasn't any specific tradable rumor flow in today's notes. What you did see, though, was the kind of intraday story traders always talk about on days like this: headline risk plus positioning, especially in those crowded mega-cap leaders. But without verified detail, it all stays in the rumor bucket. The tradable takeaway doesn't change. Watch the price action, watch the sector rotation, and wait for confirmed catalysts. Meta was one of the clean tells today, down about 2.5% on a day when the S&P heat map showed decent breadth. Meta still popped as a bright red high-weight block. That's why the session felt heavier than it looked. This read as selective de-risking in mega-cap communication services, not a market-wide panic. Alphabet. Google slipped just over 1%. It matters because it's a core index weight. When Google is red, it can overwhelm a lot of smaller green boxes on the board. Today, it reinforced the theme. Communication services was heavy, feeding that masking effect where breadth looks okay, but the index doesn't. Microsoft slipped just over 1%. This one hits differently because traders treat it as quality tech. When Microsoft trades heavy while small caps rally, it points to rotation away from mega-cap concentration, more of a positioning reset than a broad economic call. Into the next session, Microsoft is a clean sell the generals gauge. If it stabilizes, the rotation cools. If it keeps bleeding, the index can stay pinned. Intel was the standout downside outlier, off just over 4%. Semiconductors were mixed overall, but Intel showed up as an obvious air pocket on the heat map. When you get a single name break like that inside a big ETF-heavy group, traders watch for spillover, less about today's index move, more about whether the semiconductor bid is broad or fragile. JP Morgan gained a little over 2%, and that was a big reason this wasn't a liquidation day. Financials led, and JP Morgan was the clean read on that. Strength here helped provide alternative leadership while mega-cap communication and platform tech were getting sold. In plain terms, money didn't just go to cash, it rotated. ExxonMobil rose just under 1% as oil climbed on renewed US-Iran tension. This is the market's direct oil and geopolitics proxy. Exxon being green while growth-heavy megacaps were red fits the whole day's story. Traders hedging and repositioning around oil-driven inflation risk instead of ignoring it. Looking ahead, there are two big things on the dashboard. First, ongoing US-Iran and oil headline risk, the same macro lever that drove today's rotation. Second, next week's event cluster: Tuesday, April 28th, consumer confidence; Wednesday, April 29th, the Fed decision, statement, and press conference; Thursday, April 30th, advanced GDP, core PCE, ECI, and jobless claims; and Friday, May 1st, ISM manufacturing. No predictions here, just context. With that calendar, it's pretty clear why traders were tightening exposure in the most crowded leaders today. So the close today was pretty clean. Breadth held up, but leadership shifted. Megacap communication and parts of platform tech did the damage, while cyclicals, banks, and small caps helped steady the broader tape. Into the next session, the question is simple. Does the megacap selling stabilize, or does the market keep using those names as the funding source ahead of next week's macro gauntlet? Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.